All right. Good morning, everybody. TGIF, huh? We made it. We continue to see this false reality that's driving the algos. We still have some ceasefire agreement on paper, even though conflict is escalating. Shots are being fired, missiles are being intercepted, but peace reigns. We'll see how long that lasts before a new headline is big enough to force the algos to look away from the party line. We do have non-farm payrolls this morning. It's what we've been leading up to all week. We've had plenty of opportunity for them to hedge and even add additional hedging because, they're always hedged. This would be extra hedging. The idea behind this hedging technique is that surprises is what moves the market. As long as the market can see a threat coming, it can hedge into it enough that we really don't get a big move at all. The big move comes when they didn't have that opportunity and they get caught off sides, and then everybody is scrambling to buy or sell something. That forces the big moves. I know it's kind of Captain Obvious stuff, but new traders got to pick this up somewhere. So as long as there's no surprise, big moves generally get shunted due to the buffer of the hedges, and we don't end up with a big move after all. NASDAQ is up 0.75%. Japan is basically flat with Hong Kong. Europe down a little bit. The elections in Europe or in the UK were eye-opening. If you guys haven't caught any of that news yet, you got to really check it out. Now, it's at the local level at this point, but from what I've seen, the party in control just got their butt handed to them. And it seems like we're going to get another prime minister. That would be the fourth one in 4 years. Good times, huh? I believe the president is going to be speaking today at noon. He's going to deliver remarks in the Rose Garden, 12 o'clock. So once we are done with non-farm payrolls, that's your next big one. Now, if you look at everything else that we have going on today, most of these are set for 8:30. At 10 o'clock, we're going to get a little bit. The wholesale inventories, consumer sentiment. I'm not a big fan of those how you feeling sentiment gauges, but still, it is a data point, right? We don't want to ignore data. So just be aware, 10 o'clock, we could get some form of volatility. Not really expecting anything, but at least prepare for it. Just be mindful at 10 that we could get something. A couple of Fed speakers are going to be chipping their teeth throughout the afternoon. That has been an absolute waste of time. Still, a reporter could play games. They could misspeak, misrepresent something, get quoted out of context. Always be careful when you have somebody out there from the Fed talking. I'm not sure about these two European central bank speakers, but one of them is going to be speaking when the president is at noon, and then at 12:15. So it's in the same window, same block of time. Just keep your eye on that whole thing. By 1 o'clock, we should be done with whatever we're going to be getting externally, and it should just bring us back to any headline news or whatever we've got on the charts for the afternoon. So if you're looking for some 0-day plays, the morning looks like a big mess, but by the afternoon, we should have a clear sight of what we're working with. I'd say keep a close eye on the curve. You don't have to sit staring at this thing all day. Just check on it, say after 8:30 this morning, probably like around 9 o'clock, and then around 10:30, because that would give us time to get past the 10 a.m. data, and then check it around 1 o'clock. That should cover everybody that was speaking at noon and have time for any of that to be priced in. It looks like they're still unwinding those rate hikes that they started pricing in, and that's going to help try to keep the market up. We got precious metals and chips in control this morning. You see gold, silver, semiconductors, China, uranium, then the indices, industrials. It's not a bad backdrop, really. Just not enough. This isn't what's moving the market, right? 73.14 for the SPX reference price. Here's 73.50, this large bar here. And even if we was to get above that level, we've got this level 7400. These are massive, massive levels over our head. Even to the downside, if we was to start dropping back, 7300's a relatively large speed bump. 7250 and then 7200 here. Then we start to cross over into the other side. So our gamma flip point, it's so far away. This little nubby here is 7100, but I think it's really before that, right? 7150 here. Call it getting under 7200. Overnight trading volume 87,000. It is greater than the 50,000 average, but it's coming in light compared to the large 250, 200, 150,000 that we've been seeing lately. So it's a little light compared to that, but it's still heavier than the average. We still have not had a significant pullback in the market since that March reversal, or the end of March reversal. I was talking to people yesterday, when we started to sell off a little bit, and I was surprised by the sentiment. So many people just aren't catching this or grasping the logic of this pullback. This was nothing, right? If you think about how the markets began to unwind yesterday, and the sentiment from the people that I was talking to was just, they're acting like the world was coming apart. Guys, we need a pullback, and it would be a good thing to get a pullback. If you want this market to 7,500, 76, 78, getting into 8,000 by the end of the year, you really need this pullback. Without the pullback, the chances of us being able to maintain these levels and to go higher from here decreases. Now, sure, we hung out sideways for a while, and that was our correction, because we don't have to have the pullback if we can correct another way. But then we rallied out of that and went even farther. So the idea that we need a correction is there. We need something. If you look at all of the measurements that we talk about every day, how far away we are from moving averages and floor pivots and points of control, and every metric we have says we're skirting the edges of having moved too far. Now, that doesn't mean we have to fall just because we went up. But if we don't correct, then we need to go sideways to correct. We either correct in price or we correct in time. But we need one or the other. So a little bit of weakness yesterday, and we are now right back up to where we opened at 9:30 yesterday. 23.98 or 2,400 basically. We're right back where we were, right? So it wasn't some, big disaster. There was no reason to get all bared up in the portfolios, dump a bunch of positions, realign for the short side. Wasn't any cause for that. A little speed bump. We have a market maker move this morning that is telling us that they are running additional hedges. Remember, they're always hedged, right? This is extra hedges. We want to continue to keep our eye on that. We are making the assumption that they're hedging because of non-farm payrolls. It's a pretty safe assumption, all things considered. But it is still just an assumption. So after the 8:30 data print, we want to see that start to go down. And if it doesn't, then it tells us they weren't hedged just because of non-farm payrolls. They were hedged because of maybe that and something else. The trades that are happening today that's causing this market maker move to show up are being done on 0-day contracts. So it will be gone by the end of the day, simply because the contracts that are causing it won't be here on Monday. So it will start to shrink in the afternoon if it was to survive that long. What's more likely is we'll get the data at 8:30 and this will start to shrink and it'll just disappear. If you're not on Thinkorswim, you don't have a market maker move signal. Thinkorswim made it up. It's right there. But even if you're not on Thinkorswim, you can still spot it. All you got to do is have access to the options chain. If your broker has options and the options chain, then it will have these implied vol levels on the side here, on the right side. Now, every broker puts those in different places. Maybe it'll be on the left or it'll be in the middle, but that's what you need. If you look at the options that are going to expire today, their implied vol average is higher than the next number out. That's what a market maker move signal is recognizing. That's it. So it's showing that they're trading out of the money options on the front expiring contracts, which jacks up the implied vol for that expiration and gets it higher than the next expiration out. There's some really good articles about this that was written when TD Ameritrade was holding on to Thinkorswim. They had like 30 pages, 30 articles. Now Schwab owns it, and they've condensed it into, I think, 2 articles. Still, it's not a bad read if you want to learn more about the market maker move. You can just go to Google, type in market maker move. You'll find the Schwab public page that explains it. They won't talk about futures. They really just reference this tool in relation to binary events and earnings situations, things like that. But you'll at least have a better understanding of what the market maker move is. For us, it's just telling us that they are hedging this morning. They're worried enough about the situation that they're doing that, and for them, hedging is pure cost. It's not like when retail hedges and we can turn it into a trade, make some money on it. For them, if they're hedging, they're literally just burning money. They don't get it back. They don't get to recoup that in any way. And if they're willing to spend money to protect their position this morning, then they're a little concerned about what we're going to get today. Remember how I started this stream today? When they're worried and they hedge enough, it's likely we don't move much at all because nobody's caught by surprise. Nobody's scrambling to buy or sell. We don't get the big move that everybody's concerned about because nobody had to sell because they were hedged. We have already reached the ADR half. It's a market phrase that says if we get to one side early enough, we can go to the other side by the end of the day. I know it doesn't show in the whole 24-hour period, but these lines do expand into Globex, right? They just visually, they're not showing up until after midnight for us here. So in theory, we got there last night before midnight. But if you look at how we responded to it, we had a slight pullback, and then we made another run at it. Now we're holding above it, even had a little Busby. And if we can break outside of yesterday's high, we can get to the upper ADR up here. But we're going to need to get that breakout of yesterday's high, and that might be more difficult than it sounds. We attempted to break that level twice yesterday, once in the Globex, once in the regular trading session, and we wasn't able to get through there. Now, if we begin to fade and we can break this ADR half and get inside the 2 red lines, then that opens the door for us to go to the other side by the end of the day. 7,300. We're at 7,400 right now. That's some easy math. So break the ADR half, get through the midpoint of our own Globex. Yesterday's low, Globex low, then this lower ADR half. Level by level by level, right? Nothing to it. Today's floor pivot is higher than yesterday. That's bullish. Price opened underneath it. That's bearish. It kind of cancels each other out. We have a wide channel, which implies that if we attempt a breakout, it likely doesn't stick. And we're still relatively far away from the weekly pivot, but unless we break out of yesterday's high and try to go higher, then we don't have to worry about that weekly pivot at this point, right? It's only going to come in if we break yesterday's high and try to get more. Yesterday's high is basically 2.5% away from the weekly pivot. It's a bit much, but we've seen 3 and even 3.5% above that weekly pivot. So 2.5, I don't think is enough. The flip yesterday likely wasn't caused because of our distance from the weekly pivot, but we're getting close to it. 3 to 3.5, that would be a more likely level. We are already above R1, which puts R2 on the table, 74.32 cog line. If we drop back down below R1, it offers us the floor pivot and then S1, 73.28. All right, we talked about this distribution yesterday. The point of control has come up. It's now up here. That's one of the biggest changes compared to yesterday. Then we've got this other level. And then it gets really shallow. And we don't have another level until down here, right? Shallow again. And then we fill out another level down here. So one of the biggest things about the change from yesterday to today is that point of control. And having it up here with us, it doesn't act as a resistance level, right? It's acting as a structure, as a support level. It doesn't matter if we're underneath it or above it. It matters that we're with it or we're at that level. So think of it a bit like a zone. And as long as we're in this zone, then it's helpful, useful. We can hang out here, reserve some energy, like charge the batteries, so to speak. And then we can move from here higher or lower. That point of control isn't holding anything back. $74.32 cog line. If we can break this high, that was yesterday's high. Maybe this one's a little bit higher. It's not going to matter. 74.28 instead of 74.27. So like I said, it doesn't matter. There's our breakout point. If we get a breakout of yesterday's level and we make a run to the upside, 74.28, 74.18, it's the 111 and the 1236. Get there and OCC. $10-day, 30-minute volume profile and TPO. We still haven't moved this point of control as high as we would want. We shifted it from down here up into that 71.90 like we talked about. So that much we've accomplished. But otherwise, we just got this nasty mess all over the place. So it moved. It's likely going to hang out here for a few more days. And then it's a bit of a toss-up on where we're going to go next. It's likely it's going to end up here around 73.65-ish. And we should keep that for a few days, depending on where we go today, right? If we can build out this 7,400 area, or if we break yesterday's low and we build out the value area high up here, 72.80-ish. All right, we took out Wednesday's VPOC, so we're done with that. Thursday did not give us a new VPOC because we've already run through that level, so we're just done with it. We still have this one from May 5. If we do begin to unwind a little bit, drop down through the week that we've just had, then this VPOC level will become a target, a bit of a magnet. If you look at what we've done for the week, though, it hasn't been that bad of a week, especially for a week where we're looking at a hurry up and wait mode. We really didn't wait until we got into Thursday, waiting for non-farm payrolls. If we make a move to the downside today, keep your eye on this big structure from yesterday's price action. It's all of this, right? All this. We are still above the 10-day 1.6%. This is not overbought in the short term, short duration. We could easily make another 1.6% to the upside before we would start to say that, hey, we're getting a bit overbought, overextended. So right now, we're a little warm, but we're certainly not running hot. And looking at the week, we are at the extremes at this point. We are 5.3% above the 10-week. Now, anything's possible. Learned long ago not to say something like we can't do something because price can do whatever the hell it wants to do. But it's very rare for us to get above 5% and stay there for 2 weeks in a row. It happened during the recovery in COVID when the banks removed lock limits and was really trying to recover. But other than that, I don't have any markings of a sustained 2-week push above 5%. Now, that does not mean we have to fall, just that we stall or fall, one or the other. What we're measuring here is how far away we are from the 10-week moving average. This is the 10-week moving average, that blue line. $70.27. We're all the way up here. It's all the way down here. Now, the thing is, every week this thing moves. right? And if we want to sustain this distance that we have and stay 5% away, we would have to move however much it's going to move. That's how much it moved from 1 week to the next, right? That's how much it moved. That's how much it moved. Those are not insignificant amounts of movement. So we made a big move this week from last week's close to wherever we're going to close this week. If that 10 moves up, say 150 points, then we're going to have to open and push 150 just to maintain our distance. Then we would have to hold it and keep it. That's the whole idea, right? That being this far away from that 10 week and being able to keep it, very unlikely. So what's more likely is we're going to pause, stall, and or reverse and head back towards that 10 week. That's more likely. Now, because it's Friday, we have a preview of next week's range. It's not set in stone. It's still moving. It won't lock into place until after 4 o'clock today. But we get an early glimpse of the volatility or lack of volatility that's being priced into next week's range. I didn't zoom in and get this to the tick perfect because I really don't care to do that. But just kind of ballparking it there. Next week looks a lot like the week we have right now. And this week was supposed to be a narrow week because of non-farm payrolls. But last week was supposed to be a narrow week because of FOMC. And last week, this week, and the next week, they're all really close together. We're not seeing outliers here. Data that's as muddy as that is basically worthless. So our weekly expected move isn't giving us any edge right now. If it was crazy small, that would give us some insight. And if it was really large, that would give us some insight. But having the same thing last week and next week as we had this week, yeah, thanks for nothing. So it is what it is. Just acknowledge it, recognize it, and move on. We don't try to squint at it and read the tea leaves. Looking at what's down this morning, got the Mag 7 down volume is down. Yes, that's a double negative. And other than that, that's leaves us to what's up this morning. The benchmark we use is 0.5%, and you can see that all of these are up at least 0.5%. If we just look at what isn't up this morning, or what isn't down this morning by 0.5%, there's some that stand out. Financials, cloud computing, solar, some bond stuff, banks, communications. We've got the right sectors and industries this morning to make the move. The problem is that market breadth isn't in control of our market. Right now, it's what's happening in crude, the VIX, and treasuries. And I'll continue to push with that and say, watch crude, VIX, and treasuries. What about NVIDIA? Why don't you ask it in the chat since this isn't a Q&A session, and whatever you want to discuss with NVIDIA, we'll get it figured out there. today is no different than any other day in the idea that we got to get out of the box if you want to get anything else done, right? It is like it always is. GTFO. Get out of the box. Right now, the box is yesterday's Globex. If we continue this push to the upside, then it'll be yesterday's high. And I've already given the levels for that, but 74.32, 74.50, and then 7,500 today. If we don't break to the upside, watch out for the non-farm payrolls print at 8:30. Then we've got the Globex mid. Yesterday's RTH low, which is really all of yesterday's low. Then the Globex low. Then we start working our way down through this week's move. There's your midpoint on the week around 7,300. We've already hit the upper ADR half. And if we hit one ADR edge early enough in the day, we can go to the other half by the end of the day. All we've got to do is break that ADR on the upside, and we can target the ADR on the downside. This really is a laid back, nice setup. You got a clear Globex. We're still inside of yesterday's range. All we got to do is get it fired up. So keep your eye on the news. Watch the clock. Run it into the close. That's what I got for you guys. Be careful. Be safe. Have a good weekend. I'll see y'all next week.